So this is the gold INR chart. Uh, First, I want to show you how I've created this. So what I've taken is I've taken the gold price and multiplied it with the USD INR, the dollar gold price multiplied with the USD INR, and then I've multiplied it with 15% of taxation on top of it. Uh, and the typical dollar gold price is in troy ounce. One troy ounce is 31.103 grams. So divided the entire thing by 31.103 grams, and that's how you essentially come out with 5720 is the current uh, derived price of gold in India with all duties, uh, import duties, and etc. And 5722 rupees per gram. This is the last couple of decades of gold. Very impressive by itself. We were at 400 rupees per gram. We are now at 57.21 per gram. More than double digit CAGR. People keep bashing gold for whatever reasons that they like. But what I'm going to show you is how, if you are allocating to gold, and if you want to, let's say, add more allocation, and you want to try to time that market, how you can use certain very simple tools to do that. So let's just look at, for instance, a very simple moving average. So this is 200 week moving average. So this is a weekly chart, and I've put a 200 week moving average. So essentially, whenever gold is below 200 week moving average, it's a blind buy. You want to buy for the long term, just blindly buy it whenever it is below 200 week moving average. Because if you see, in the last 50 years, there have been only so many instances, in 82 here, some periods in 85, then very minor periods in 98, then some minor periods in 2015-16. These are the only periods it has gone below this 200 week moving average. So very very strong, uh, indicator that gold is heavily oversold whenever 200 moving average is close. Now let's go a step forward. Let me add another indicator to it, the simple RSI. So this is simple RSI on 14 week data. Now, what you can do is, okay, so gold is not coming below. Let's say right now it is not coming below the 200 week moving average. So how long should I wait? I don't want to wait that long, because sometimes, for decades it does not come below this average. So now I can add a another layer of indicator. I'll say whenever it is above 200 week moving average, but it is oversold in the RSI charts, I will take a bet there. So, for instance, in the last 6 7 years, if I take, let's say, 40 is my level of being oversold in gold. Uh, that is the start of getting oversold at least. And post 2016, I can say, maybe somewhere around here, somewhere around August 18, then somewhere around March 21, then somewhere around September 22, and now just recently, we've had those points where the relative strength was extremely oversold on the weekly basis, yet the overall trend remains on the higher ground. So these are extremely good points, and these are not, sure shot, buy situations where nothing can go wrong. I'm not saying that, because if you go in the past, maybe the 200 week moving average was here and it got oversold here, and you could have bought here, right? And then you could have had to wait for next 3 4 years for that oversold position to be overcome, and then go and then going up again. So the larger picture is that allocation is for very long term, that is for sure. Within that allocation for very long term, if you wish to come in at points where the probability is very high that you are doing the right thing at that time, then use these kind of overlays on the entire structure of these indicators and to get better entries for the asset allocation. I believe in totally asset allocation. I don't believe that one should be trading gold unless you are a trader, on a daily, weekly basis. I think for the long term perspective, one should be invested in this asset class as percentage allocation, and every year if you should review your allocation and accordingly adjust. So from that perspective, when I know that I'm not going to get out of this position for a very long period of time, it may be better that whenever I bring in new money, I bring in at those points where I think the probability is much higher.